How to survive an economic downturn and still make huge returns. In the event of a financial catastrophe, you might be risking everything and caught unawares if you're not prepared for a downturn in the economy at all. It's not uncommon for individuals to lose their jobs, which seemed stable, see their retirement savings cut in half, or even lose their homes to the bank during these times. Such events can lead to lasting health implications and troubled relationships. It's easy to forget the times of misfortune when the economy is performing well for an extended period, but the effects of slowdowns should never be minimized. Fortunately, economic downturns also present massive opportunities for those with a high level of financial stability, offering the chance to build incredible wealth beyond what was imagined. Learn how to properly prepare for unfortunate times, so you can take advantage of opportunities as they arise. If you're interested in improving your financial future, make sure to subscribe to the channel and hit the like button if this video is helpful. What is an economic downturn? A substantial drop in economic activity lasting longer than a few months is referred to as an economic downturn. It can be caused by various factors, including inflation, when prices rise and the dollar weakens, deflation, when prices fall and the dollar strengthens, high interest rates, and lending problems. These issues typically lead to higher unemployment, a lack of consumer confidence, people losing their homes, and businesses going bankrupt. As a result, the stock market usually plummets as investors panic, lose confidence, and pull their money out. Live below your means. One essential habit for improving your finances, regardless of the economic cycle, is to live below your means. This means spending less than you earn, with the gap between your income and expenses being used to invest in your future and pay down debt. Unfortunately, many people fall into the trap of continually increasing their expenses in proportion to their income, leading to a never-ending cycle of barely scraping by. When they get a raise, that money is often immediately allocated to a new car or a larger home. When their tax return arrives, it's already spent on a vacation. The phrase "live below your means" might sound boring or mundane, but it can lead to positive changes in your life. Diversify your income. Did you know that an average millionaire has 7 sources of income? They don't rely on a single paycheck to cover their mortgage, car payments, and other bills, reducing the constant worry of being laid off. When your income is diversified, you have less reason to worry if one stream dries up. By combining living below your means with diversifying your income streams, you'll still be able to pay your bills during unfortunate events. Pay off debt. One of the best advantages of having multiple income streams is the chance of one stream taking off. For example, someone working a full-time job might start a side hustle detailing cars on weeknights and weekends. If the car detailing business becomes a hit, they could quit their full-time job and focus on the business, potentially earning double or triple their previous income. Paying off debt doesn't always make sense in every situation. It's wise to pay off high-interest debt quickly while making minimum payments on low-interest debt. Instead of using every extra dollar to eliminate low-interest loans, that money could be invested to earn more interest than you're paying. However, consider how low your monthly expenses would be if you had little to no debt obligations. This puts you in a much better position during an economic downturn and allows you to sleep better at night. Avoid regrettable purchases. Think about the purchases you've made that you later regretted. Perhaps a new car that's now dented and having mechanical issues, or a timeshare you were convinced to buy while on vacation. There's nothing wrong with spending money on things that bring you happiness, but the problem arises when people habitually make large and small purchases without thinking. Continually wasting money on things you don't care about shortly after purchasing them will drain your wallet and leave you wondering where all your hard-earned money went during a financial crisis. By thinking twice before making expensive purchases, your future self will appreciate it, and you'll find more joy in each dollar spent. Know what to expect. When the stock market crashes or an economic downturn occurs, it can feel like the world is ending. However, it's worth noting that the average economic downturn occurs every 4 years and lasts about a year and a half. The average bear market, when stocks drop at least 20%, occurs about every 3.5 years and lasts between 9 and 10 months, with an average drop of around 35%. While it's unsettling to see your investments lose value, especially as you get older, knowing what to expect can make these events easier to handle. Remembering that markets are not always positive will encourage you to prepare your portfolio for such occurrences and avoid owning anything you wouldn't want during a downturn. Maintain leverage. Always maintain a safe amount of leverage, meaning don't borrow more money than you'd be comfortable with during all market cycles. Buying stocks on margin might seem foolproof when the economy is strong, but it's a different story when things turn sour. Would you still think it's a good idea, or would you be over-leveraged? Similarly, borrowing against the value of your home might seem manageable now, but what if your income decreases? Borrowing money has potential upside, but it's crucial to avoid over-leveraging. Considering each market cycle will help you do this. Buy low, sell high. The worse off the market or economy is, the better the opportunities are for profit. As Warren Buffett famously said, be fearful when others are greedy and greedy when others are fearful. Investors who are well positioned to buy assets at a discount are often rewarded when those assets return to their all-time highs. Investing on the dip adheres to the tenet of buy low, sell high. Purchasing stocks at a steep discount to market prices and holding them for the long run is an easy technique, even though timing the market precisely might be difficult. This strategy is prudent only if you have a large amount of capital to risk, but for those who do not, a recession may present an opportunity. It's easy to forget how things looked during past recessions, especially for younger individuals with little to no memory of them. When the economy is thriving and seemingly invincible, bad times become distant memories. Remembering these times and always being prepared for them means you'll be in a much better position to withstand an income interruption or a major loss in your portfolio value. It could even give you the opportunity to take advantage of incredible value in the markets. Compare this to someone who is ill-prepared and expects nothing but a perfect economy and constant uptrend with their investments. They might lose their home, encounter major problems in their family, and face many other detrimental issues.